There are 5 banks that are distributing dividends like real money machines. As the global financial market faces uncertainties, fluctuating interest rates, and geopolitical tensions, these institutions are not only resilient, they're thriving. They're delivering consistent, and in some cases, surprisingly high, dividends to their shareholders. Today, we're going to talk about some entities that have demonstrated exceptional financial management. Each of them has been selected after carefully analyzing their balance sheets, payout ratios, business prospects, and future stability. Banks, being large, stable businesses with relatively predictable cash flows, tend to be among the best dividend payers. It's not uncommon for many of them to have a solid dividend policy, which consists of paying out a fixed percentage of profits to their shareholders each quarter or year. Some can earn dividend yields as high as 10%. Not bad, right? It's more than double what U.S. Treasury bonds pay. However, not all dividends are created equal. Some companies offer very high returns, but at the cost of a risky and unstable business. Others, on the other hand, pay less but are impressively stable and increase their dividends year after year. Therefore, what we look for here are banks that offer a balance of profitability, security, and sustainability. Number 5. Banco Santander, Spain. Santander Bank is one of Europe's financial giants, with a presence in Spain, Latin America, the United Kingdom, and the United States. Despite the continent's economic ups and downs, it has maintained a strong and consistent dividend distribution policy, making it a favorite for investors seeking passive income. In 2025, Santander's dividend yield is expected to be around 3.24% per year, a very competitive figure. To put it more clearly, if someone invests 10,000 euros, they would receive approximately 324 euros a year in dividends alone, not including the likely increase in the share price. This return is especially valuable in a context where traditional deposits barely yield any interest. But Santander doesn't just stand out for its dividend. It has also strengthened its balance sheet, reducing unnecessary debt and diversifying risks. This has increased the confidence of institutional investors who value not only the current dividend, but also the bank's ability to maintain it in the future. A key element of its strategy is its growth in emerging markets, such as Brazil and Mexico, where it achieves much higher banking margins than in Europe. These regions provide robust cash flow, which serves as a foundation for further increasing shareholder returns. Furthermore, Santander combines its cash dividend with share buyback programs, which not only delivers cash directly into investors' pockets, but also reduces the number of shares outstanding, increasing the value of each remaining share. This dual strategy positions it as an attractive option for both those seeking short-term income and those focused on long-term growth. It's certainly a heavyweight to keep an eye on in 2025. Number 4. Toronto-Dominion Bank, Canada. TD Bank, one of Canada's largest and most influential banks, is recognized for its outstanding financial stability and conservative approach to risk management. It offers a dividend yield of 4.81% today. While it may seem moderate compared to some European or Latin American banks, it is one of the most consistent and sustainable in North America. What makes TD Bank unique is its ability to grow without taking on excessive risk. Unlike many U.S. banks, which have been exposed to complex derivatives and toxic assets for years, TD has opted for a solid and gradual expansion, particularly emphasizing its presence in the United States, especially on the East Coast. This market, one of the largest and most competitive in the world, gives it access to a diversified base of retail, commercial, and institutional clients. For investors who value security and reliable dividends, TD Bank is a standout choice. For more than 10 years, the bank has consistently increased its dividend payments each year, demonstrating a steadfast commitment to its shareholders even in difficult economic times. If someone decides to invest $10,000 in TD Bank stock today, they can expect to receive approximately $480 in dividends annually, with a good chance of this figure growing progressively thanks to annual adjustments. Furthermore, it benefits from a strong reputation in corporate sustainability rankings and employee satisfaction, which translates into operational efficiency and lower employee turnover. This combination of prudence, International expansion and long-term commitment keeps TD Bank as one of the best banks for those seeking passive income and stability in their portfolio. If you found today's video helpful, don't forget to give it a like and subscribe to the channel so you don't miss out on future content. Now, let's continue. Number 3. Bank of Nova Scotia, Canada. Scotiabank, formerly known as the Bank of Nova Scotia, is not just another of Canada's financial giants, but also an international powerhouse with a significant footprint in Latin America and the Caribbean. This geographic diversification clearly distinguishes it from other major North American banks, which tend to rely primarily on their domestic markets. In 2025, Scotiabank offered a dividend yield of 6.2%, a figure that places it among the most generous banks on the continent. But what makes Scotiabank particularly interesting isn't just the numbers, but its resilience. Unlike banks focused solely on North America, Scotiabank draws diversified revenue from countries like Peru, Chile, Colombia, and Mexico. This international expansion not only provides it with attractive banking margins, but also acts as a shield against recessions or slowdowns in a single market. If one country suffers difficulties, the others support the balance sheet. That's the advantage of its diversification. Furthermore, Scotiabank boasts an impressive legacy. It has been operating for more than 180 years and maintains one of the oldest and strongest records of continuous dividend payments on the planet. This longevity is a powerful sign of stability, prudent management, and commitment to its shareholders. It's also worth noting that the bank's management has shown a consistent focus on optimizing its profitability and strengthening its efficiency programs, ensuring it can continue to increase dividends in the coming years. Scotiabank, therefore, combines historical strength, international presence, and juicy dividends, making it a hidden gem for those seeking robustness and profitability in the banking sector in 2025. Number 2. HSBC Holdings, United Kingdom. HSBC is, without a doubt, one of the global banking titans. Although its headquarters are in London, its true heart and financial muscle lie in Asia, with particular strength in Hong Kong and China. In 2025, HSBC has a dividend yield of 5.86%, an impressive figure considering its colossal size and widespread international presence. This means that for every $10,000 invested, shareholders are receiving about $563 annually in dividends. What makes HSBC so attractive to dividend investors? The answer lies in its recent strategy. In recent years, HSBC has undertaken a massive reorganization of its business, shifting away from less profitable regions and concentrating its efforts in Asia, where margins are higher and the growth potential is enormous. This approach has not only allowed it to strengthen its revenues, but has also optimized its cost structure, improved its operational efficiency, and consolidated an enviable capital position. Furthermore, HSBC has a long tradition of rewarding its shareholders, not only through attractive dividends, but also through share buyback programs, which multiply the value for those who maintain their investments over the long term. However, not everything is rosy. A significant part of HSBC's performance is closely linked to the economic dynamism of Asia, particularly China, which introduces certain geopolitical and economic risks. Number 1. Banco Bradesco, Brazil. At the top of the ranking is Bradesco, one of Brazil's financial giants. By 2025, Bradesco offers a dividend yield exceeding 10%, an impressive figure. For every $10,000 invested, shareholders receive more than $1,000 annually. Furthermore, its share price has increased by more than 15% so far this year. What's fascinating about Bradesco is its ability to thrive in an emerging market that, although volatile, offers extremely high margins. Brazil has significantly higher interest rates than developed markets, allowing banks to generate significant profits on loans, credit, and other products. Furthermore, Bradesco has proven resilient in the face of Brazil's political and economic turmoil, maintaining consistent payouts to its shareholders. However, this bank is ideal for investors with a riskier profile looking to maximize passive income, aware that emerging markets can offer both great rewards and significant volatility. These 5 banks stand out this year not only for the size of their dividends, but for their combination of financial strength, sustainability, and growth prospects. Each represents a different type of bet. Santander, with its exposure to Europe and Latin America, TD Bank and Scotiabank, with their Canadian stability, HSBC, with their Asian muscle, and Bradesco, with the juicy Brazilian market. It's crucial to remember that while dividends are an excellent source of passive income, they shouldn't be the only factor to consider. The bank's financial health, growth prospects, and long-term strategy are equally important. Investing in dividend-paying banks can be an excellent way to build wealth, but always with a strategic and well-informed approach. If you choose wisely, you'll not only gain a steady source of cash, but you'll also participate in long-term capital appreciation. So, before jumping into a buying spree, it's advisable to thoroughly analyze each bank, assessing its geographic exposure, dividend policy, debt level, and the consistency of its growth. This way, you'll not only build a dividend-oriented portfolio, but also appreciate it over the long term. Have you invested or are you planning to invest in any of these banks? Do you know of any others to add to the list? If you enjoyed this content, don't forget to like it, subscribe to our channel, and activate the bell to receive notifications of our upcoming videos. See you later.